we go. Ladies and gentlemen, we'll get started very, very soon. Just want to make sure we do a bit of housekeeping to make sure you can actually hear us, you can see us, and you can see that first slide, which says managing your finances as an Australian in the United States. If you can raise your hand if you can see it, or drop a comment in the chat, or even a question, just to confirm that you can hear us as well as see us and see the slides. There we go. Thanks, Andy. Thanks, Cameron. That's great. Thanks, Carl. All coming through loud and clear. We'll give it 1 to 2 more minutes and then we'll jump into today's webinar. That's great. Everyone's filing in now. I'm going to keep talking briefly just to make sure you can continue to hear me, see us both, as well as the slides. If for some reason you find any tech issues, be sure to jump into that chat and let us know if you can't hear us, just so we can try and do some troubleshooting very quickly. I used GoToWebinar last night, so it seemed to work all fine. So it should be all good for today. Yep, it's good. Thanks, Ashley. That's great. Yep. All right, we're a few minutes past. Why don't we get into today's webinar? So everyone, thanks for joining us today. I guess we're going to welcome a few different people. We've got expats, Australian expats over in the United States, as well as Americans in Australia, dual nationals. And today we're going to be talking about managing your finances, whether you're a dual national or an Australian expat in the United States. We'll touch into it and do a bit of housekeeping. If you do have any questions as we move through today's slides, please do submit them in the question box. We're going to do a bit of Q&A at the end, just so we can get to them. We've had a lot of questions submitted prior to the webinar, which is great. We will be making recordings available as well. They'll just go out automatically from GoToWebinar once we finish it off, as well as a copy of the slides. Let's jump into it. Really appreciate everyone joining us today. A quick disclaimer. Whenever doing a webinar, we must have a disclaimer. And all this is saying is anything you see or hear today should not be taken as personal financial or tax advice or any form of personal advice. It's mainly for information and entertainment purposes only. Sometimes we're entertaining. If you do need advice, please do reach out, seek advice from a professional such as Jason, who is a registered tax accountant or a tax lawyer, or even an accredited financial advisor. Very important. Who is the Atlas Wealth Group? Well, we are a leading provider of Australian expat financial advice, tax, mortgage and asset management services. We are regulated by ASIC, which is one of the main regulatory bodies here in Australia, the ATO, which we've all heard of, and the DFSA, which is over in the Middle East. We have clients in over 45 countries, and all of our specialists are degree qualified with numerous postgraduate certifications. Who is Uptrend Advisory? They are the leading provider of US tax preparation services and tax advice for Australians in the US and Americans in Australia, because you both have the same problem dealing with the IRS. Regulated by the Chartered Accountants Australia and New Zealand, as well as US CPA requirements. Team members all qualified with relevant degrees and certifications. Your panelists for today, that good-looking rooster on the left-hand side there, that is Jason Schoch, who is the Managing Director for Uptrend Advisory. Myself on the right-hand side, James Ridley, I'm the Managing Director for the APAC region. So my office here on the Gold Coast, we mainly assist our clients, Asia Pacific and the Americas region for the wealth management arm. Jumping into today's agenda, I'm going to be talking about tax treatment of assets when leaving Australia, a very important one. Jason's going to jump into US tax treatment of Australian assets and some structures, a really good one there. I'm going to then dive into about RSUs. RSUs is a really common one for Australians when they get over to the US, depending on who they're employed by. And then we've got some terrific Q&A to run through at the end as well. So as I said, if you do have any questions, please submit them as we go. We look forward to addressing them at the end. Moving into today's topic, tax treatment of assets when leaving Australia. When we first leave Australia, there's technically two types of assets in which the ATO says you own, maybe. And that's taxable Australian property or non-taxable Australian property. We love to just obviously shorten that to TAP versus non-TAP. So taxable Australian property is things which are relatively physical back in Australia. So that might be a former main residence or an investment property that you leave behind in Australia. So think about bricks and mortar type assets that you often rent out. It can even be an indirect interest in Australian property through ownership of, I suppose, a very large asset through, say, a trust. It can be a mining quarry or a prospecting right in Australia. It's essentially an asset that you're leaving behind, which you might rent out or keep vacant. A lot of expats, when they first head over to the United States, they do sometimes leave behind a former main residence, which they rent out, or an investment property. So that is a TAP asset. Non-taxable Australian property assets, or non-TAP, these are things which are often traded, maybe on an open exchange. So direct shares, exchange traded funds or managed funds, mutual funds, listed investment companies, or even Australian real estate investment trusts. That's often what is categorised as non-taxable Australian property. And when we first leave Australia, we actually have a really important decision to make. And it's something that we deal in and day out. And it's whether we opt into what's called deemed disposal or deemed deferral. So both very different. The image that we can see on today's slide is a really clean example of deemed disposal. When we first leave Australia and become a non-resident for tax purposes, if we own shares as an example, and we've held those shares for a number of years, as of that date that we leave, that's when we're essentially opting into deemed disposal, and we are crystallizing the capital gains on paper, and we'll pay a bit of tax on that capital gains, just at our normal Australian marginal tax rates. But it does mean there is a benefit there that when we live in the US, the capital gains that keep accruing on that portfolio back in Australia are no longer taxable by the ATO. So that's the benefit that we get. In the event we don't opt into deemed disposal, well, that's when we're actually opting into deemed deferral. So it means that we're not going to do deemed disposal as of the date that we become a non-resident, which is usually wound up in that final Australian tax return. We're going to keep holding that portfolio until we return. However, we now miss out on some concessions. So for that period that we're owning that portfolio whilst we're overseas, we no longer get access to what's called the 50% CGT discount concession for that portion of time that we hold it. If we do need to sell it whilst we are a non-resident, we are going to be paying tax to the ATO at our non-resident rates. And I would say that we'd get a tax credit on the US side, but it would also be taxable by the IRS. Remember, if you're a US tax resident, taxation on a worldwide basis. So there can be some disadvantages into doing deemed deferral. I guess a real common question that we get from expats is, well, should I be opting into deemed disposal or should I be opting into deemed deferral? So a really good question. I suppose the other component of non-TAP assets is income. So dividends, distributions, those sort of things. So that income is still technically reportable in Australia, but it really depends on the type of income. If you're receiving fully franked dividends, not actually reportable on your non-resident Australian tax return because you do have that corporate tax credit attached to that. If you're receiving unfranked dividends and there's no withholding tax come out of it, then you are meant to report that to the ATO. And then there are different types of income from different types of investments, such as managed funds. That can be in the form of capital gains. If you're investing in foreign ETFs, then you've got what's called conduit foreign income, and usually that's not assessable by the ATO due to it coming from a foreign source. So there's little, I suppose, intricacies associated with those different types of assets. But all in all, the hardest question is always asking yourself, well, what is right for me? Should I be opting into deemed disposal or deemed deferral? It really depends on how long you're going to be overseas for. And I guess if you're only going to be heading over to the US for a 1 to 3 year period, maybe you're just using an E3 visa for a short period and coming back to Australia, Normally, we would say that's probably not an applicable time frame to be opting into deemed disposal, and you might just keep the shares as they are in the background and not do too much with them. You do need to be mindful of the types of shares, such as ETFs, and I'll let Jason talk about that in a little bit, but sometimes that can create more of a US tax burden, so it might be wise to actually remove the exposure. But if you're only over in the US for a very short period, due to the associated share market volatility that we've seen, even in just the last 3 years, deemed disposal might not be the right fit for you, because you might accidentally pay tax on something now that ordinarily you wouldn't have, a year later, because the share market might have pulled back. And last 2 to 3 years is a terrific example of that. What about TAP assets, taxable Australian property assets? What do we need to know when we leave them behind? Well, often we usually rent these assets out, an investment property or a former main residence. Because we are earning income on those back in Australia, it does mean we do need to keep reporting them on a non-resident tax return. So often I come across expats which have held a property back in Australia for a couple of years. They've been reporting all the income and everything to the IRS, which is great, but they haven't been doing anything with the ATO. You are meant to still do your normal non-resident tax returns back in Australia. So that's capturing the income, the expenses, maybe you're accumulating some tax losses as well. That's a tax asset. So it's really important that you do lodge. The rates in which you pay are non-resident tax rates. So they are a little bit more punitive on positively geared property income, 32.5% on the first net dollar. And that first tax tier is 0 to 120,000. One, I suppose, concession that you no longer get access to is that 50% CGT discount concession. So you do get access to that concession for the period that you've owned that asset as an Australian tax resident, but unfortunately, they did remove the concession back in May 2012. But again, if you've only just left Australia and you've just headed over to the US and you have an investment property back in Australia, you still do get access for that period that you've owned it and you've been in Australia as a normal resident. So absolutely. So it means in the event you ever sell that asset whilst you're in the US, some pro-ratering is required. The other big concession that we no longer get access to as a non-resident is what's called the main residence exemption. So this was a big one they introduced. They actually announced it back in the 2017 budget, and then they abolished it as of the 30th of June 2020. They made the announcement in December 2019. But yes, that caused a lot of stir and concern for expats that they were finally going to have to pay tax on their former main residence, which is, I suppose, very draconian. So that's an important one as well. We're still meeting expats where they're unaware of that. They're unaware that that concession has been removed, but it's very punitive. So make sure you educate yourself. When we look at income, yep, still reportable from those TAP sources. And negative gearing, it still can be done technically. You can still accumulate income losses back in Australia and grow that tax asset to be used at a future stage when you return back to Australia or that property becomes positively geared. That's it for me today on that topic. I'm now going to run through Jason's slides. Over to you, Jason.
Thank you, James. Thank you to everyone for joining. The most, important thing to understand when it comes to how the US views your Australian assets is, firstly, whether or not you actually need to disclose them, and that is driven by your tax residency in the US. So, if you're a non-resident for US tax purposes, you do not disclose worldwide income or assets on your US tax returns. If you are on a temporary visa, such as a J1 or an F1 student, you can be exempt from being a US tax resident for a number of years, but after that, you're going to be subjected to the substantial presence test, which is essentially a physical presence test that determines whether you are a tax resident or not. So most expats and Aussies in the US are going to be on visas like E3s or H1Bs, which will be subject to that substantial presence test, which if you passed will make you a US tax resident in the exact same way holding a green card or being a US citizen would. So if you are a US tax resident, that is when you must begin disclosing worldwide income, assets, and structures on your US tax returns. So for US tax purposes, when you have Australian assets, your cost basis remains the same as when you purchase them in Australia. You do not get a step up in cost basis. If you performed a deemed disposition, like James was talking about, on shares or other assets in Australia, it will not impact your cost basis for US purposes, and it will also remain the same as when you purchase them. When you earn income from Australian sources, such as bank interest income, dividends, capital gains from selling assets, rental income, business income, it will all be reportable and taxable by the US. It is then a matter of leveraging foreign tax credits at the federal level to offset tax paid by the ATO against what the IRS wants to calculate. And an important consideration is actually which US state you reside in and whether they abide by the federal tax treaty or not. Examples of states that do not abide by the tax treaty are California and New York, where you would be double taxed on those same sources of income that I had mentioned, while a state that would recognize the tax treaty is North Carolina. So that is an important consideration when thinking about planning where you're going to be living in the US. The next important topic is selling a rental property in Australia. So while you can have capital gains discounts for selling an investment property in Australia or paying no capital gains tax at all on your primary residence, as a US tax resident, you still must disclose it to the US, and the tax treatment is quite different compared to Australian tax law. So under US tax law, when you're selling a home that you've lived in for 2 years out of the most recent 5-year window, you're exempt on $250,000 of capital gains if you're filing with the filing status married filing separately or single, or this increases to $500,000 US if you're filing under the status married filing jointly. Any amount above those thresholds would be taxable by the IRS and state that you reside in. So in a situation where you've paid zero tax to the ATO as it was your primary residence and you're above those thresholds, this would mean you're actually paying tax to the IRS and state where you would not be paying tax to the ATO due to the differences in tax law between the two countries. When it comes to selling an investment property, you will have long-term capital gains rates at the federal level where you will be able to claim foreign tax credits for tax paid to the ATO. However, depending on the level of gain, there is a 3.8% surcharge levied by the IRS under what's known as the net investment income tax, which goes above and beyond the treaty. And then at the state level, it then comes back to, does the state have income tax? And if so, does that state abide by the tax treaty? So it is critical to have proper planning in place, as there have been a number of instances that taxpayers have sold properties in Australia without considering the knock-on impact to their US tax liabilities. And once it's done, you can't change it. James, could you head over to the next slide? Okay, so now that we've covered income reporting and tax treaties and credits, we can move on to the unique requirements of the IRS and their view on everything foreign. James, you were talking about punitive things. Well, we're going to be getting into that. So when you have foreign assets being non-American that exceed 10,000 US dollars, when you add them together, you must complete what is known as an FBAR. This is a foreign asset disclosure form that goes to the FinCEN. It's an annual compliance form where no tax is calculated, as the FinCEN mainly deals with crime and anti-money laundering. Depending on your filing status, due to the FATCA regime, you may also need to file what's known as a Form 8938 on your tax returns. This is threshold based as well. So if you're filing single or separately and your assets added together are over 50,000 US dollars, you need to file this form every year in your tax returns. If you're filing jointly, this jumps to 100,000 US dollars. This form goes in your tax return and also requires you to identify what income has been generated from those assets and where it has been reported on your tax return. It's kind of a reconciliation form. You're not typically taxed on the balance of those assets through those forms. The IRS then has a view on non-US domiciled mutual funds, index funds, stapled securities, ETFs, units, you know, a blended fund. And this is what James was alluding to earlier, but if you have this, it's likely going to be viewed as what is known as a passive foreign investment company, or PFIC for short. This will trigger a special Form 8621 per fund that you've got to report annually, and allows the IRS to not only tax the dividends, interest, gains yielded, but also the unrealized gains as well. Let's say you've invested in a Vanguard in Australia worth $10,000 at the start of the year, and at the year end it's now worth $20,000. Well, the IRS could see it that you made $10,000 via the mark-to-market methodology and expect you to declare that as income in your tax return. If this wasn't punitive enough, there's also tax preparation fees to consider in filing these forms, as they can add up if you do have multiple PFICs. So, you know, depending how long you're staying in the US, we generally recommend that you avoid investing in these types of funds while in the US tax system, due to how they're treated. Superannuation. So when it comes to superannuation, it's extremely gray because the tax treaty does not call out superannuation explicitly. And so what this means is all accountants have their own interpretations and their own view on how it's treated and whether it should be taxable or not. If you had discretionary control over your superannuation fund, it would be viewed as a foreign granted trust by the IRS, in which case the growth would be taxed year over year. An example of this is a self-managed super fund. If you did not have this fund, then it is about determining the level of control, which can mean a few different things. Having the ability to choose where you invest your superannuation, which all Australians do, or having the choice to make contributions to superannuation, or who has made up more of the composition of the fund. Is it your employer or yourself? So, as the IRS has not made any official rulings on what constitutes control for superannuation, it's all up to interpretation and for you to rely on your accountant and their guidance. The last area of complexity lies in non-US structures. So if you've got an ABN in Australia and it's active and it's got a business name like Jason Consultants, you will trigger an informational form called an 8858, a foreign disregarded entity form, that will require you to declare not only income, which you would always have to declare anyway by being a US tax resident, but also a lot of information about the business and financial statements. So while you're in the US, if you hold an ABN and you're not using it, it's recommended that you wind it up, so that way you don't have to report an additional form each year. Proprietary limiteds, or PTY limited. So if you have more than 10% ownership in a PTY limited, you will trigger Form 5471, which is the IRS Foreign Corporation Form. This is the most complex form that the IRS has, and they will not only want the financial activity of the business, but also ownership information of all of the shareholders. The IRS are also able to tax the profits in the business beyond tax paid to the ATO via a special tax called GILTI, which is ironic. It stands for Global Intangible Low Taxed Income. This GILTI would be levied on the individual taxpayer who has those shares in that entity. Trusts. If you have a trust in Australia, which is common for Australian tax planning purposes, and you are the trustee of the trust, you must complete Form 3520 or 3520A annually, which is the IRS Foreign Trust Form. It allows the IRS to see the financial activity within the trust and possibly tax the profit of it, whether it's distributed to you or not, as an individual. If you're just a beneficiary, in the year you receive a distribution, that is when you would need to file that form and then pay tax on your share of the trust distribution, which again, you would be declaring anyway as a US tax resident. So as you listening, I hope you can all appreciate that the US tax system is quite heavy on the compliance side when it comes to foreign income, asset disclosures, and structures. Each of these forms do carry heavy penalties for non-compliance, so it's important to bear that in mind. If possible, simplification is recommended, as that will not only reduce your tax exposure, as well as the reporting fees to accountants such as myself, by closing old trusts or companies that you're not using, or winding up those PFICs to avoid those kinds of forms. Over to you, James, for RSUs.
Thanks for that, Jason. That some terrific insights there, and I think we can all agree how complex the US is when it comes to tax reporting. I don't know how you keep up with it every year, especially when some legislation changes are made. It's enough to drive you mad. So, well done. We'll jump into some RSUs. I mean, RSUs 101 for Australian expats. I mean, I see a lot of my clients when they first head over to the US. And based on the employer, they are given this as a terrific benefit. RSUs stands for restricted stock units. It is a terrific benefit that can be dumped on a lot of expats, as well as, I guess, just general US tax residents. They are a form of company equity compensation, so essentially having shares dumped on you. Used to incentivize employees. They're sort of, I guess, sometimes referred to as the golden handcuffs. You have all these different vesting periods and you're getting a lot dumped on you, but it's over a 10 or 15-year period. And that's why people hang around. They're a really good way to secure long-term employees and talent, absolutely. They are provided through a vesting plan and a distribution schedule, whether you're achieving performance milestones or just remaining with the employer for a certain period of time. There are tax implications when they vest, and sometimes expats aren't aware of this, and then they get a nasty tax bill at the end of the year. And often, I think the issue which comes about, which Jason's talked to a lot of my clients before about, is the whole under withholding, which we'll jump into shortly. But that's obviously one of the tax implications and issues which can come about. How do they work? Well, there's a grant date. So this is a date that they're actually promised to you as an employee. That's not a taxing event. That's just something that's given to you via the vesting schedule. Then there's that timeline over which the RSUs will become your shares. And I guess a good example of that is when they vest. That vesting date, that's essentially when they're assigned to you and they're in, say, your Morgan Stanley ShareWorks account, and you can actually trade on them or do something with them. And at that point in time, that is when they're distributed. So what about tax? Good question. So, and this is often the confusion that I see with a lot of Australians, because in Australia, we do get something similar to RSUs, but the taxation's a little bit different, just because of different tax legislation, that's all. So it is taxation or taxed, these RSUs, at the point at which they vest. So on that date, that is when they become income in your tax return. Often when they do vest, a portion of your RSU tranche, when it vests, is usually sold. And it's sold as a portion of withholding tax, and that amount goes automatically to the IRS. Often the withholding rate is roughly 22%, and that is actually where the issue arises. Because it's only 22% and you likely haven't told the employer to withhold more, or the platform, and let's say that you're on a very good wicket, you've got other different incomes, you've got bonus, you've got your salary, your actual average tax rate might be higher than that 22%. And the reason, the issue that arises, is because you've got more tax to pay at the end of the year because it's under withheld. So it does mean you do need to engage with an accountant to look at what's the best strategy to make sure that doesn't happen and you're prepared for that. I know Jason, he helps a lot of his clients with, I guess a bit of a pay-as-you-go system to encompass those RSU tranches, or updating the relevant withholding amount based on your income, doing a bit of tax planning around that. Taxation at sale. So should you continue to hold them and not sell them, the normal short-term capital gains rules apply in terms of taxation, or if you hold them for over 12 months, long-term capital gains rules apply. The cost base is typically what the share price was at the time which they vested to you. On that date, most, I would say, platforms actually give you a price in which they're vesting to you, and that's what you're going to use to form your cost base if you're going to hold on to those shares for a very long time. This next slide is actually a really good flow chart of understanding the different I suppose, events which happen along the way. So we can see there, it's a bit fuzzy. So I'll probably need to make that image shorter before I send out those slides to you guys today. But did your RSUs vest? Yes, RSUs will be taxed at income based on price at vesting date. Did you sell your shares? No, no taxes. Did you sell the shares? Yes. Before selling, did you hold your shares for more than 1 year? No. Okay. Paying short-term capital gains? Yes. Paying long-term capital gains. If they're vesting and you're selling them straight away, it's going to be a very small tax event, CGT event maybe, but you're already paying tax on them from an income aspect as well. And I guess a common question I get from clients is, well, how should I be managing these RSUs? What should I be doing with them? What should you be using them for? It's a really good question, and everyone is different. It's obviously going to be driven by your own goals and what you're trying to achieve over the next 2, 3, 5, 10, 15 years. I think an important one is diversification. Probably the biggest lessons we've seen in the last 3 years. We've seen massive tech companies share price capitulate. Meta's a really good example, where the share price essentially halved. So anyone that was receiving these RSUs and they're getting dumped on them, but they weren't doing anything with them, well, their wealth in that one stock would have essentially been cut in half. So we've seen that happen, and that's why I guess that is the general price of inaction. By not acting and having a strategy around managing our RSUs, you could lose a significant amount of wealth against and compared to diversifying across maybe a few different strategies, you know, putting down into some debt or using it to buy a property, putting some in your retirement accounts, putting some in your emergency fund, shoring up your coffers, your savings buckets, all those sort of things. So there's a lot that can actually come from them. I guess diversification is really important because you're just reducing unsystematic risk, you know, overexposed to a bloated holding. That's really important. Timing of sale in the future. This is a really good one. This is one that Jason also works with a lot of our clients on is, you know, when might be the right time to sell some of your RSUs in terms of optimizing your tax position. And that might be to do with returning back to Australia, essentially winding up your tax residency with the US and recommencing your tax residency in Australia, optimizing your positions there, selling before or after is really important. Selling in a year in which you might not have any wage income because you're returning and you've already resigned. These are just some examples. Money management. This is another one I see some expats fall foul of. Relying on RSUs to fund your ongoing lifestyle and cash flow needs. So your base wage isn't enough. Your ongoing lifestyle costs, mortgage payments have now risen to include your RSUs. That's a big no-no, and that's very dangerous because RSUs aren't a guarantee. You can't control the share price, and what happens if your employer makes a change to their RSU policy. So just be mindful of that your ongoing living expenses, mortgage repayments, everything should not encompass your RSU income. You should only be living off your base, and then the RSU should just be extra surplus that you're using to keep building your wealth in other avenues. If you're relying on your RSUs to just fund your day-to-day, as well as your bonuses as well, well, then you're living beyond your means. You should only be relying upon your base salary. That is a really, really important one. We're now going to head over the slide and move into actually a bit of Q&A as part one of our webinar series. I've had a lot of good questions that have come through, and I'm just going to read some out. But if you do have some questions, please submit it into that question box. So I've got one here that was submitted about exit taxes for Australia. Does Australia have an exit tax when you first leave? It absolutely does, surprisingly, and that's actually just that deemed disposal event. And whether you're opting into deemed disposal or deemed deferral, that's when an exit tax can come about. If you're going to head over to the US for, I guess, a very long time, that's the exit tax which can actually come about and can also mean, yep, paying a bit of tax now, but ideally you're paying that tax now so that way you can accrue wealth in essentially a tax-free manner whilst you're in the US, assuming you don't crystallize any capital gains whilst you're in the US and then coming back. I guess if you are going to take up US citizenship and green card, then that's another issue, but we won't jump into that today. There was another question that was sent in about exit taxes in the US, and I don't know if we'll answer that one, Jason, because we probably answer that one on the next webinar. Is that right?
Yeah. I mean, exit taxes is its whole own thing, but
Yep.
definitely we will be covering that. Yeah.
Yep. Yep. Okay. Makes sense. Some good questions filing in now. There's a good one actually, which I'll throw over to Jason, and it's about Texas. Is Texas affected by the tax treaty based on the state taxes in Texas or lack thereof?
Yeah, so because there's no state income tax in Texas, you don't have anything to declare to Texas with regard to Australian income or assets or structures.
Yep. Yep. There you go. Pretty
But
straightforward.
if you're in Texas, you're lucky.
You are. I mean, hearing all the complexities around dealing with the IRS. I know if I moved over to the US, I would be going to a a tax-free state. Absolutely. I just, really feel for those people living in, California, New York, those sort of ones where the state taxes are horrendous. Um, a good question that we've just had filtered through. Does ownership of non-taxable Australian property assets in Australia have an impact on your tax residency for ATO purposes? Oh, good question, Andy. Um, and I guess one thing which might come into this is when they look to update the tax residency rules in Australia. One factor that I know might be impacted by that is Australian economic interests. So right now, it doesn't have an impact on your tax residency. It's sort of pretty easy to hold Australian assets, share portfolios as an example, no PFIX, just direct shares back in Australia, and that not have an impact on your Australian tax residency. You can still be a non-resident. One thing which might have an impact on that in the future is the modernising tax residency rules, but based on tiebreaker tests within treaties, I still believe a lot of our clients and Australians in the US will still be able to keep their non-residency, even if they're coming back for that 45-day rule that they're looking at updating. But we'll go into that as part of another session. But no, right now it wouldn't have an impact on your tax residency being a non-resident of Australia by owning non-TAP assets. There's a good one here, and with some of the personal questions that are coming through, we just need to be mindful that you're not taking it on as personal advice, guys. So there are some which are quite personal. So just bear that in mind. We'll do our best. There's a good one here. I'm 55, been working in the US for 11 years, relocating back to Melbourne in January 2024, so very, very soon. What's the best strategy for moving my 401k funds back to Australian super? Ooh, it's a good question. Jason, did you want to have a crack briefly at this one?
Yeah, sure. So, firstly, there's no way to roll over 401k into super because it's not recognized as a like kinds fund. So you will need to withdraw your 401k, at which point you'll pay marginal tax on however much you've withdrawn. If you're over 59 and a half, you avoid that 10% early withdrawal penalty. And then it's just a matter of, did you withdraw the 401k when you are an Australian tax resident or not? Because the ATO will tax your 401k withdrawal. James, I believe Atlas just released a nice article about that today so great
Yep.
timing. I do suggest you read that article as that kind of covers exactly what the ATO will do to it. But that is a very common consideration and conversation I have with their clients as to, we're planning to move back to Australia. We've got all of these assets, 401k is it? What is the right timing for us? And there's a whole bunch of different buckets as to like taking it all out now, taking it all in a low income year, taking it when you're in Australia and retired, and taking at the tax-free threshold. It's very customized and personal, but I hope that kind of answers your question and gets you thinking about all the variables in play.
Yep. No, great answer there. Um, and good shout out for the LinkedIn post as well. In terms of another question, I don't know this one. I haven't heard of it. Jason, this is another one for you, but don't need to answer it if it's too personal. Can you claim expenses of investment firms on Form 1116? I haven't been doing that, but wanted to check if it's a thing. I've never heard of it, so I'm not sure.
So Form 1116 is the foreign tax credit form, and that's typically where you put all of the foreign income that you're declaring and then try claim a tax credit against it. There is a line that says, what are the expenses directly related to this income? And that's typically done, when you've got a rental property, you put the gross rental income and then all of the outgoings against it, and then the foreign tax credit nets against it. In terms of being an investor, I can't answer off the top of my head if you can do that, because that sounds like a bit of a niche situation as to,
Mm,
are you an active investor, a passive investor, are you a day
mm.
trader? There's different tax code for those situations.
Yep, yep, really. It looks like we've got a few more for you, Jason. So prepare yourself. Um, but this one's a good one. Is there any tax benefit? Oh, sorry, I'm reading it and more questions are flowing in, so it keeps dropping. Is there a tax benefit to selling Australian employee shares prior to leaving the US, Texas in brackets, while the shares are free of capital gains tax? There's a few things into that one. Is there a tax benefit to selling Australian employee shares prior to leaving the US while the shares are free of CGT?
Well, there's two perspectives. There's,
Mm,
at a very base level, what's your cost basis? What's your selling price? If the delta is a capital gain, well, then it's not CGT free
that's
um,
right.
for US tax purposes, assuming you've got wages and other things. On the Australian side, it goes back to what James was talking about as, is it still taxable Australian property or is it not? Did you do a deemed disposition before and you're now doing a deemed acquisition where on the day you land, you sell and there's no difference? It just really depends.
Yeah, it does. Yep, tough on that one. And that's as Jason put, that's really specific to your individual situation. So that's something that might actually require a bit of written advice around that one. Um, Another one here. As an Australian living in the US, should I continue to contribute to my super fund? That's a good question. I think Jason and I will both have a very similar view. When you're contributing to super, and Jason talked about foreign grant or trust, and then it can be the other type of trust technically, but then it comes down to a few things. Often, a lot of my clients that have contributions going to super, it's actually still being paid into by their employer. So we won't usually, I guess, openly advocate for very large amounts being deposited into their super fund, because unfortunately it just can create very large US tax nightmares, where I think I've seen before an expat has made use of what we call in Australia the non-concessional contribution cap, and they've put in 200,000 because you can actually put in up to 330, which is triggering 3 years worth. And then on the US side, they had to report that as income in their US tax return. And at the same time, it converted their super fund into a foreign grantor trust. So, and then Jason talked about it, but then that opens up PFIC reporting as well. So it just sort of had this flow-on effect, and he's like, oh no. So we personally don't, I guess, openly advocate for big, large contributions into super. A lot of our clients are lucky in the fact that they're still getting some of their employer contributions going into their super, which often means they're not getting a 401k benefit. So that's probably the best way I can answer that one, Jason. What were your thoughts?
Yeah, I mean, I pretty much align with exactly what you said. You're helping the Australian side, but then hurting the US side. So it's kind of that fine balancing act. And then, if you're not putting money into super, where do you put it? Do you put it in shares in the US market or Australian market or properties? And that's where it comes back to your investment and wealth, strategy, which, James can point you in the right direction. But for tax purposes, yeah, you're hurting yourself on the US side.
That's right. Yep, absolutely. There's a good question here from Lisa, just about what sort of US retirement account should I set up for a 10-year stay? Guys, we are going to be doing another webinar in a couple of weeks. So keep an eye on the socials, LinkedIn, your emails. We're going to do a little bit of a deep dive into US retirement accounts, tax treatments, all those sort of things. So we are doing another webinar only in a couple of weeks' time. So we'll be talking about that tax treatment as well. So I'm not going to answer those questions today because we're actually going to do a session on it together. So look out for that coming very soon. But a really good question, Lisa. But I'm assure you we'll be addressing that question on the next session. I guess when we look at exiting a PFIC. So exiting a PFIC, is it better to exit when a capital loss or a small gain is unrealized?
So think of the mark to market methodology that I talked about as just one input in your tax return. Same as, if you had bank interest income of $100, it's just going to flow into everything, or it's added to your W-2 income and all of your other income, and then tax at your marginal rates. So if you're selling for a small gain, then it's not going to materially impact your tax outcome. It just means that in future years, you don't have to deal with the forms and everything like that annually, or if the market goes up, then you suddenly have a big spread year over year, which you're not going to get a foreign tax credit for because you're not paying tax to Australia on an unrealized gain. If you have a loss, then that loss can offset other gains in what is like a very common strategy called tax loss harvesting. So either way, it's really situational and personal preference. For tax purposes, if you have a loss, you can use the loss or carry the loss forward to future years where you've got a gain. If there's a small gain, then it's not going to materially swing your results. And then it's just about, again, saving yourself in the future where there will be big variation in price and value and everything like that.
Yep, absolutely. And a good question here. You mentioned deemed deferral and deemed disposal as two options, or option one, option two, for existing non-TAP assets when moving from Australia to the US. Do Australians living in the US have similar obligations if they purchase new assets while living in the US? So, Andy, that sounds like you're talking a little bit about whether there's an exit tax when you're leaving the US and heading back to Australia. We're going to actually touch on that on the next session, Andy. So, really good question. Don't want to answer today because I want you guys showing up to our next webinar in a couple of weeks' time. So, hold fast and we'll address that question, Andy. I'm actually going to throw that as a note because it's a terrific question and it's actually a really common one for a lot of my clients when they're first leaving the US and coming back to Australia and wanting to know how it should all be treated. One question here, with an Australian inheritance where there were some shares sold before final distribution, is there any tax on that portion of the inheritance in the US? Probably a few things coming into that, Gidgee, but a US tax resident receiving an inheritance, Jason, what usually needs to be reported roughly?
Yeah, so if you're receiving an inheritance from a non-US person, so not a US tax resident, and if the value of what you've received in a calendar year is over 100,000 US dollars, be it property, cash, stock, whatever, you do need to disclose it via a form 3520. That's typically the foreign trust form, but there is a section in there where if you received a gift or bequest or inheritance in the year, you just complete that disclosure. You're not taxed on the inheritance, it's just a compliance form. Let's say you inherited shares and then sold the shares subsequently, well then that's when it's a regular capital gain at that point in time.
Great. And another question here from Adam, and it's around deemed disposal in Australia. So if I paid my exit taxes in Australia when I left on my shares, when I sell the shares when I'm in the US, how does this affect when I go to sell the stock, considering the tax treaty between the US and Australia in regards to not taxing the same income twice? So I guess probably depends on when the US would see the cost base start. Jason, any feedback on the cost base on those Australian shares?
So just to clarify, it's shares that were acquired in Australia and then sold
Yep.
while in the US?
Yes. Yep.
Okay, yeah, unfortunately, your cost basis is the exact same as the day you originally bought them. There's
Yep.
no step up, unfortunately.
It's a shame, really, because you get the benefit of the deemed disposal on the Australian side, but well, we all know what the IRS is like. If they can tax, they will. So
Yep.
be mindful of that and just make sure you're aware of it. Educate yourself. What's the right strategy. But good question, Adam. When we look at, I suppose, a few things, Adam, there's actually, I'll come back to you on that one around COVID. That's a really good one. There's another one here about super. Following on, does holding an Australian super account without making contributions count towards the 25,000 USD PFIC threshold while a US resident?
So if you're just holding a traditional super fund, typically no, but there are some super funds that do kind of veer in that territory. The one that I can think of off the top of my head is Q Super. James, I think you dealt with that in the past, where they just invested in a whole bunch of different PFICs, and unfortunately it wasn't avoidable. But most funds, you can avoid that kind of designation.
You can. Yep, absolutely. Um, There's a question here just about what seminars are we planning to do for Aussies in the US. Lisa, we do have another one coming up in a matter of weeks, and keep an eye on Jason's socials as well, because it is tax time. Jason will be doing another webinar very soon separate to us. And I really encourage everyone to try and get on that one as well. Some great little tidbits and nuggets will be coming from that one. There's another question here around a small Australian SMSF. Superannuation. It's getting a big start today, isn't it? And I guess it's probably, it is the reason why it is such a grey area. So this one might need to be pulled apart a little bit, Ash, but I'll read it out for the audience. But I think, Jason, this is more personal advice, so you don't probably need to answer it. But small Australian self-managed super fund, it is totally dissolved, no distributions. How should this be filed with the IRS? Can it be considered sale of equity and treated as capital gains? When I read that and when I hear dissolved, I assume that the super's now back into, say, like a retail super fund, like Australian Super or CBUS or something like that. So that's a really good question. Jason, that's probably a little bit too personal, that one.
Yeah, unfortunately it is too personal, but I will say at minimum, you would need to do the 3520, because at a period in time in the year you did have an SMSF, which is a foreign grantor trust. You will need to mark final on that form, so that way for future years the IRS doesn't expect it. And why I say that is because the IRS has software where if you've done it once, they're going to expect it automatically the next year, and if you're a day late, you get that automatic penalty. So marking final is critical.
Yep. A good question from Adam, and it's actually mainly during COVID times. So I had stocks when I was in the US. I had to move home back to Australia for a period, I think just over a year and a half, due to COVID, just because the visa process until the visa came available, and then moved back over to the US. And the question was around, do I need to do deemed disposal? That's actually a really good question, Adam, because through those COVID times, the HO released some, I suppose, guidance around whether your tax residency had recommenced. So I would dare say you might actually need a private ruling to identify whether you need to do a deemed disposal event on those shares, or whether they can be tax exempt from the ATO because they were from US. That's probably not a clean answer. I'd say you need private ruling and some written advice around that scenario, because that happened to a lot of Australians and a lot of expats. They were forced back to Australia, couldn't renew their visa, COVID times. You had shares all over the place. They were down, then they were up. And then you had this event where deemed disposals might have been happening, but they weren't happening on very large capital gains. So I actually saw that happening with some of the tech firms as well. So I think you'll need a private ruling there to identify how it should be treated. Another question around inheritance. So we'll see if we can answer it. Inheritance follow-up question. How is tax deemed if you're inheriting multiple Australian properties while living in the US? It's a good question. I think it probably depends on if it's if you're inheriting from a US person. Does that be right, Jason?
Yeah, the first thing is it from a US person or not? And then based on that, that form that I just mentioned, and then where the property is located. I know Australia has a bunch of rules around if it was their primary residence versus an investment property, and then similar thing on the US side. So that one's something that I would recommend you get personal advice on, just because the treatment can differ greatly.
That's right. Yep. Another question here, just regarding SMSFs and dissolving them. What if you arrived in the US and the year you dissolved and returned the funds to industry firm? Do you need to submit the form still? I think it probably depends on whether you were treated as a US tax resident in that year that you arrived, or whether, which Jason actually talked about the substantial presence test. So if you haven't been in the US at all and you're arriving in, say, September, well, often anything outside the US isn't really, I guess, captured until 1st of January, and then it's worldwide basis. Is that right, Jason?
That's right. The only caveat to that is if you're on the green card or you're a citizen of the US, you don't get the substantial presence test. It doesn't matter if you're there, you're always going to be a US tax resident. So Substantial presence test is, the main test, but then there are some cases, where it doesn't even matter. You're just always going to be a US tax resident.
Yep. And then a question that's been submitted about investments in Australia. Is there any I should avoid? And is there any tax structures I should avoid when I leave into the US? It's a good question. I think we've probably addressed that question. PFICs are the big one. Self-managed super funds, they can give you a lot of grief as well. And then, as Jason said about different tax vehicles, which are really common. So in Australia, your discretionary trusts, your companies, those sort of types of structures, depending on what you're doing with them, they can cause additional tax and additional reporting in the US. So you really want a clean bill of health when you head over to the US, and you want to try and keep things simple. You can still accrue a vast amount of wealth in the right manner without using those structures. And it can be due to your non-residency or your opportunities over in the US. It's often when you're coming back from the US, and if you're not a green card holder or a citizen, well, that's when there's a lot of exciting opportunities which open up as part of that repatriation planning. So often you're better off going over there squeaky clean, removing PFIC exposure, or essentially having a strategy in place to make sure you're not holding PFICs, those sort of things. Good question from Gidgey. Yep, there'll definitely be a recording video made available after this webinar. Absolutely. We're sending out the slides as well, so you can capture those. I'll try and clean up that graph, which was a little bit fuzzy. There's a good one here around the tax treaty that I've seen come through before. Do you know whether they'll look at updating the tax treaty to include super and other vehicles in the near future? It's a good question. Jason, thoughts on the tax treaty?
Yeah, I would love it to be updated. I think most accountants would, so that there's no more gray, it's just black and white, as well as, taxpayers, that, you can have proper planning and avoid, all the subjectivity. If you haven't already joined, there is a Facebook group dedicated to this called Fix the Tax Treaty, where people are lobbying and constantly sending in letters and everything to try enact these changes. Because I do know last year they were taking feedback on the treaty. It's just a matter of, is something actually going to happen, or is it going to sit on a table and be looked at in 5 years' time? Unfortunately, we don't know, but I would love it to be updated and changed.
Yep, absolutely. And then there's a question that is here around managing currency and a question around mortgages and HECS. So that's sort of referring to loan rebasing. It's actually a really good question, but it is one that we are going to be covering on the next session. So we'll keep that one in our back pocket. Managing currency, that's actually probably an easy one in terms of currency platforms. Often with a lot of my clients, I make sure they're using a currency platform rather than going from bank to bank, just because of the exchange rate that you'll usually get. And that's just money management. That's not anything tax related. If you're sending money and you're a non-resident of Australia and you're sending some savings back from the US back to Australia, that's not a taxable event here in Australia, just because you're a non-resident. Remember, when it comes to what the ATO will tax you when you're a non-resident, it's only what's happening within our shores, property, taxable Australian property assets, maybe some dividends in Australia, which are unfranked, just local ones held here on platforms. But when you're sending money back in terms of the currency, that's not a taxable event, not at all. That's tax exempt. So those are little things. But yes, I do encourage a lot of our clients to make sure they are using essentially a currency platform, because you're often getting a really a much better rate. We've seen that time and time again. No more questions have flown through today that aren't too personal, so we might wrap it up there for today. You can see on the screen and on the previous screen QR codes to book in some consults. So that's Jason's right now. So it is coming up to tax time. Before we blink, we'll be sort of towards the end of January, and then it's, I suppose, hell to leather in the tax season again. So please jump on there if you do need some assistance, and Jason can put you through his normal process and workflow. I do encourage everyone to get on our socials, LinkedIn especially. Get on there, connect with us, follow us. That's a really good avenue for you to stay updated, especially with what's going on around the world, because it's a really tough one to keep track of, just because we've seen time and time again how quick legislation can just keep changing. I'm sure next year we'll be talking about something else. The legislation change might be the residency changes coming through. We'll have to wait and see. Really appreciate everyone dropping in today. Jason, appreciate your time as well.
Thank you, James. It was great, doing this with you, and thank you to everyone that attended. I'm really looking forward to the next one. And as James, gave a shout out, we are starting to take signups. All of our existing clients are, already re-engaging us. So if anyone needs help with this upcoming season, please reach out. Happy to help. And yeah, look forward to seeing you all at the next one.
Sounds great, guys. Thanks for dropping in. We'll see you on the next webinar in a few weeks' time.